Hey guys, it really is great to have you all back online, and I think we're going to have a great session today. So I'm going to get started and have a look at what's coming up before us. Now, today is the end of the month, as you know, 31st March. It's an interesting end of the month because it's also the end of the quarter. Now, end of the month, end of the quarter, these are significant times in the financial market. So you can expect that monthly traders, people who, or institutions whose business is really built on what happened by the end of the month and how that monthly candle or monthly buy is looking, they're going to be active in the market because they want the market to close at a certain level. But also what's interesting is end of the quarter. So, I mean, quarterly reports, all sorts of things are taking place. So you can expect some pretty dramatic movements. But then again, we may or may not get them. What's also interesting, I just have Forex Factory open on the side here. If we have a look at Forex Factory, my time 2:15, which is about 2.5 hours or so from now, we're expecting to get ADP non-farm employment change. Now, that's red news on my calendar, and every time that I have red news, I have to exercise caution. So if you take all those factors into account, the end of the month, end of the quarter, we got ADP non-farm employment change. ADP itself can have some dramatic movements. It's possible. We also have we also have non-farm employment change tomorrow, which for me will be very dramatic because if I look at Forex Factory tomorrow, about 2:30, there will be 3 red news announcements all taking place at the same time. Average hourly earnings, the month on month, the non-farm employment change, and also the unemployment rate, US unemployment rate. So those will be dramatic. But for today, let's just keep in mind the ADP non-farm employment. So again, as we look at the charts in front of us, the 3 currency pairs that we are trading, again, we always have to have it's the same approach every time that we come into the marketplace. It's the very same approach. You always have to have your parameters set up, and I have shared this in the past, or discussed in the past. But what I'm going to do, just in case you are watching this for the first time, I'm just going to go through each of the 3 currency pairs: so euro versus the dollar versus the CAD, USD CAD, and the dollar versus the yen. Those are the 3 currencies that I'm trading on the 5-minute time frame. Now, why 3? Because that's what I'm comfortable to trade. If you can process things fast enough, comfortably enough, and are comfortable to add a few more currency pairs to your chart, that's perfectly fine. If you only want to focus on one currency pair, that is also fine. I mean, for a long time, I traded the Aussie to the dollar, and then I traded the sterling, the cable, pound to the dollar, and then I've added 3 to my mix as I become comfortable with it. I mean, guys asked me to have a look at the chart. I can just pop up on the chart and you can look at it. It's the same price action patterns that we look for to trade. So have a quick look at the euro. So this is what I've got on my setup now. This magenta or purple line that is reflective of the open of the European session. So for me, that's when I came into the market today. I wasn't up early as I would have loved to do. I was busy with some private stuff that kept me up late last night. So this is what I am looking at now. So I've come into the market, and although you can see I'm marked it at 10.55 on the MT4, because I just want to see what actually happens with that very first candle of the day, just to see if I can get any indication of where the market is likely to go. So, guys, just whatever questions you have, just pop them up into the question box. The red line, I got a bit of an echo. Just hold on a second. Everything is switched off here. Okay. So I'm not sure why there's an echo, guys. But anyway, let's carry on, because I don't have anything else playing in the background. So that first candle for me is very important, because it gives me a signal as to who is commanding the market as the market opens. At that stage, it was the bulls that were commanding the market, in control of the market. So I just keep that at the back of my mind. But because I'm coming to the market, then I don't ignore everything that's taking place to the left. So that's important. That's the day's market that is taking place. Also, the other thing that I've marked, so that's the low of yesterday, the red candle. You can see the market drop beneath that. Let me look at this a little bit more just now to see if you can understand what is taking place. The green line is the high of yesterday. Those are very significant levels to watch when you're trading intraday, basically. But on the 5-minute time frame, I want to have them there. So if the market moves towards there, and I don't have time to flip between time frames, I can see what's going to happen, decide whether to take profits at that stage, or look for a test of that stage, and see if we're going to get a breakthrough, confirmed breakthrough, or a bounce back, and the reversal into the reversal setup. So as it is right now, we are kind of going sideways, but we're not going sideways aimlessly. That's why I absolutely love price action. Have a look at this. The market, that was the high of the Asian session, and then the bear sold off and attempted to break beneath the low of yesterday, and they failed, because we created a double bottom and then a setup to go long. But between the high of the session and the low of the session, that is a trading range. So you always got to think to yourself, if I have any trading range of any sort, 1 bar, 2 bars, several hours, it doesn't matter. If I do get the market breaking above that, how far, or breaking above it or below it, how far is the market likely to go? Well, you always have to think of a measured move. The market tends to seek out a measured move of the equivalent, that's the equivalent height of the trading range that is broken out of. So I set up, I'll just put in this measured move, and again, let me just take it off just in case you're seeing that for the first time. So I use that instrument there. Okay, so there's the height of my trading range, and the market is going to seek to get to that measured move. So if for any reason you were in the market at that stage and you had decided to take a trade down here, and you could have if you were in the market, because you always want to see the pattern and then you want to see the entry. So your pattern would have been a double bottom, and then you would have seen a micro double bottom here, because you're buying at the bottom of a trading range, legitimate trade. I always have a low risk. I don't put my full risk on when I am trading. It's basically a trend reversal. So when I'm trading what appears to be against the trend, although it's in a trading range. So you put a little bit on it, then wait to see what you get. If you're taking your profits here, that is perfectly legit, because the bulls did not break above the trading range. So you could have taken your profits here and then waited to see what else would get. Now, at that point, if you had taken your profits there, I would then have to wait to see what happens at the measured move. If you saw a pullback, wanted to take a trade, remember, keep your risk low. You can still do that quite legitimately, but still aim to take your profits there. When we look at the trade that I want to look at, where in the Asian session, I made 2.4% profits, I will be able to show you how you can take an additional trade there, but aiming for the measured move. Because if you take the trade here, that's a measured move. That's where you want to see if the market is going to break out. The bulls could present strength, and you could have that bull candle, another bull candle, and a follow-through bull candle. So you don't want to miss out on a trade because you're going towards a measured move. But if you're in a trade and market starts to turn at the measured move, then take your profit. So at this stage, we are at this measured move. Okay. So this measured move, we're just going to wait. We have to wait and see what happens. We can't initiate any reversal trade. Why can't we do that? Because we don't have a confirmed pattern as yet. Any reversal trade, I need to see the market breaking beneath the 20 moving average. That shows me that the bears have got strength. And then I would like to see if the bulls are strong enough to try and resume the trade. And if they're able to do that, will the bears who created the break beneath the moving average be strong enough to create a double top? And if they can, then we wait for a lower high and take the trade. So as of now, the market is still bullish, and we have to wait and see what else comes up. Just have a quick chat at questions. Just make sure I don't fall behind. What time frame is best for swing trading? Is trailing bar by bar better than price action? So let me answer the first part. What time frame is best for swing trading? Any time frame is best for swing trading. So you could be trading the daily time frame, or you could be trading the hourly time frame. Whatever time frame that you decide to trade, then you need to be confident and be assured in your psychological makeup that when a trade initiates itself, you are able to hold onto the trade until you get you optimize the profits. Now, you've got to define swing trading for yourself. Do you take a trade? If I'm trading intraday, and I'm in a strong trend, and I can trail my stops, I'm very happy to take partial profits and trail my stops until I get a reversal. But very rarely. Let's assume the particular trend carries on beyond, throughout the whole day. Trend from the open of whatever session that I'm trading carries on. I'm fine with that. But when it gets to the end of the day, as I trade the 5 minutes, I don't like to carry my trades over. I like to close the trades and then leave it and then get up in the morning. Very rarely, and I'm talking less than 5% of times, do I leave a trade in the market. And I would do that if I've optimized my profit, if I've banked my profits, and my stop loss is in a secure place, and it's far away from any movement that might occur in the Asian session. You never know how far. So I've done that before. The returns have been good, but it's not my preferred style. For me, swing trading is any setup that allows me to make at least 2 to 1. Whatever my risk is, 2 to 1. If I can get that, I'm comfortable to call that swing trading. A scalp trade for me is like this example that I was giving you, and let's say the entry is to the measured move is less than 1 to 1. I may be comfortable to take that, make 0.5, etc. Well, happy to do that. So define what swing trading is for yourself. You don't want to say, okay, I'm taking a trade, it's a swing trade, I'm walking away and ignore what is happening with price action, because you might get a clear reversal before you get your 2-to-1 or 1-to-1 target, in which case you want to get out of the marketplace. Is trailing bar by bar better than price action? I'm not quite sure what you mean bar by bar versus price action. Okay, so firstly, trailing, I presume you're talking about trailing stops. Do you trail stops? Now, everything is price action, because price action is what's unfolding in front of you. So I trail my stops based on the price action in front of me. If the market is moving up, if I'm in a bull trend, I want to wait until I see the next higher low. When I see the next higher low and the market moves beyond that, then I can move my stop to beneath that. Then I wait again for price action to unfold. And as it repeats itself, then I can trail my stop in that way. If the market starts to break out strongly and I have successive breakout candles, bull or bear, then what I do in that situation, if the candles are large and they're successive, I just wait for 2 candles to close, and then I trail my stop beneath that in a breakout, because then I get a sudden reversal. So hopefully I've answered that. If not, just re-clarify the question, and I'll jump straight into it. So that's currently where we are with the euro. So here's what I was speaking about. So we have a break beneath the 20 EMA, and if the bears are able to have a complete close beneath here, and if this candle doesn't reverse and close above the moving average, then I have my first tick for a possible major trend reversal. Break off the trend line and close beneath the moving average. Then I want to see the trend resume, create a double top. If I have that, then I want a lower high. Then you can trade it short. So same kind of thinking in terms of what you always have to do for the daily setup if you trade in the 5-minute time frame. So the green is the high of yesterday, and the red is the low of yesterday. Keep those in there. The vertical purple magenta is the open of the present session. That horizontal magenta line is the open of the day. I keep an eye on that because I want to see who's controlling the day. As long as price is below the open of the day, the bears are in control of the day. If price is above that, the bulls are in control. If I look on the daily time frame as I come into the day and I just see a succession of dodgy candles, well, the market may continue to create dodgy candles. So if I'm beneath the moving average, then I'm going to wait with an anticipation that if I get a reversal, it may just want to come and test the open and create another doji on the day. So that gives me very valuable information just to keep in front of me, back of my mind and in front of me. So as I came into the session, and always what's happening at the left, there is this trading range. And always when you see a trading range of any sort, you want to say, or if I get a measured move, when the market breaks beneath it, will I get a measured move? So in this case, the market has broken beneath it, but in that there is a measured move. But I just want to point out something. Although the market has fallen below the trading range and you're looking to see if you get your measured move, every bit of information that we get bar by bar, candle by candle is absolutely important. So have a look, just wind back to when the market started falling beneath the trading range. What do you see? I mean, if you have a look at it, there is a candle that broke beneath that low. Okay, so that's broken beneath the trading range. But what happened immediately thereafter? The bulls reversed the breakout failed. If the bears were strong, they would have put one candle, strong close beneath that low. They would have put a successive candle beneath that. So you have a breakout candle, you have a follow-through candle. As soon as you have those two factors, then in my mind, I call that a confirmed breakout. And that's important because then I can actively start to look for a pullback. If the breakout is strong, that first pullback could just get to the 10 EMA, which is this dotted line. Just so there's a 10 EMA. So you get a pullback to the 10 EMA. And if you get that pullback to the 10 EMA after a confirmed breakout, 2 successive candles, and you have a decent reversal candle, take the trade. You've got to take a trade because that's a pretty decent setup. But here we didn't get that. The market is still falling. We had an inside candle, so inside breakout mode. So that's one of the patterns we talk about at some stage, when you have an inside candle and outside, and then another inside candle. That's a breakout mode, which you're carrying in the right context you want to trade. But here at the bottom of the trading range without successive follow through, that's not something you want to trade. Even if it looks good on review, that's not something you want to trade, because you want to take trades that give you a higher probability of success. In any case, the market has gone sideways and we did not manage to get to the measured move. So what does that mean? All that means is that the bulls are strong. They're able to repulse the market and ensure that the bears don't get down to this level. Does it mean we have a reversal? It doesn't mean we have a reversal as yet. We've got to wait for the reversal pattern to set up. So right now, market is going sideways. What you want to see is a strong close above the moving average. We've had attempts to break above the moving average, but we haven't had a strong close above the moving average. This may turn out to be the first one. If it does, good for the bulls. But unless you have successive bull candles coming up here, then there is no motivation to take any trade. Just have to know, okay, bulls are strong enough. We've put a close above the moving average. Let's wait to see if the bears can attempt to resume the trade, because what are we looking for? We're looking for a double bottom. If we get a double bottom, then we just wait for the higher low, and once we get the higher low, happy to take our trade. So that's kind of where we're at. A question you may ask is, would you have been able to take a trade up here, assuming you were in the market? Well, there is the open of the day. That's where the open was. The market came back, tried to break above that, failed, created a double top. Now, for me, although this looks beautiful, I would not have been comfortable to trade that is my take that as a trade. I would see that as the double top. These two are pretty close to each other. I would see that as a double top. I would have wanted, if I was in the market, a lower high somewhere in this area. If you get that lower high, then take the trade. Now, some guys ask me, well, George, what if I want to take the trade? Well, if you want to take the trade here before you get your lower high setup, you're taking a high risk trade. Why do I say that? Because if you go back and just test your strategy, if you just take a double top without a lower high, you find out more often than not that you get stopped out if you put a stop here. The market may attempt to resume again and create maybe some form of a wedge pattern or a triple pattern up there. So if really you are tempted, this is not my strategy. If you are tempted to take a trade, the only place you could put your stop is a potential measured move up here, because then you got to say, okay, if I'm wrong and the bulls try to break out, chances are they want to go up a measured move. So if you want to go up a measured move, you can't put your stop anywhere in there, because that's a recipe for getting stopped out unnecessarily. So put your stop right up here. I mean, that's the call you have to make. I would rather not do that. I would rather wait. That kind of double top, I want to wait for a lower high. We didn't get that here. So if I was in the market, I would have just been sitting and waiting to see what takes place. Okay, so yen, let's have a look at the yen. Again, same kind of thing. So that's the low from yesterday. That's the high from yesterday. And if you flip over to the daily time frame, you can actually see just how strong and how bullish the yen has been. So we are holding up above the high of yesterday. But have a look at what's taken place since so far in the day. Okay, market went sideways here and then broke out. Now, they at that point, okay, although that's the high of yesterday, at that point, if you're in the market, there is your breakout candle. That one has broken out above that and also broke above yesterday's high. There is a follow-through candle, very decent confirmed breakout. Then all you want to do is wait for a pullback, and your pullback came back immediately thereafter. So you're ready to put an entry here and put your stop down here somewhere and hope for a measured move. So let's just plunk it in there. So if you had done that, you'd have been able to get a one-to-one return. The entry is there. Okay, and if you put your stop down here, there's one-to-one. If you wanted to put a tighter stop, just find the low of where the breakout candles begin. You could put it there. But there is the safest place to put your trade. You could have got a one-to-one trade, which would have been fantastic for you. Now, okay, so what we then presently have at the moment, again, same kind of thinking. There is market is going sideways. There is a trading range. We broke beneath this, closed beneath the moving average. So in this particular time, the bears are strong in this area. And the question that you got to ask yourself is, well, if the bears are strong, but we're still holding above the moving average, what are they attempting to, sorry, not above the moving average, we're holding above the high of yesterday. What are they trying to do? How far do the bears want to go? So what I put in here for you is, and we spoke about this a couple of weeks ago, this leg one pullback, leg two move. So the bears have put a first leg. So I've come into the market and I'm looking left. What's happened before? And I see there is a first leg by the bears, and right towards the open, there is a pullback. So all of this is a pullback by the bears. If they have put that leg one, pullback, leg two, so there it is. Okay, so there is leg one ends here, and there is a pullback. Now the second leg, how far is it likely to go? So the second leg is likely to go down here to test the high of yesterday, because you can't ignore this bullish strength. So even if the bears are strong, at best their first effort is to try and test the high of yesterday. So if you had taken that trade, you could hold if you wanted to hold through the pullback and wait to see how far the pullback goes, and then see if you can take your profits down here. When the market continues to go sideways and starts to break above the moving average, then of course you can take your profits a little bit early. I also put this measured move here. I mean, this sideways price action is a trading range, and if they break beneath that, how far they're likely to go. So, you thought you want them to go this far, but the bears didn't make it. So at this stage, the bulls are active in the market. They stepped aside, and all of this pullback, if you are strong in the market as a bull, you're looking back and say, okay, there's the high of yesterday, which we broke above. And the bears, unless they can create a break beneath the high of yesterday and beneath the open, then the case still remains strong for the bulls. So that's currently where we're at. So again, it's an interesting waiting game. It's always fascinating when the market moves and you're able to make the profits that you make. Like and I look at the 2% trade that I made in just over an hour on the CAD. Those opportunities present themselves, and when they present themselves and you are in the market, you have to take the trades. You have to take the trades that set up according to your setup. You can't debate it. You don't know the distribution of the trades. Just take the trade. So I'm going to have a look at the trade that I took on 26th of March, which was last Friday. I was up early Asian session. And have a look at the CAD and just show you how the 2%, 2.4%. I'll show you the CAD entries. Interestingly enough, as of now, unless I see other setups, and if the setups work in my favor today, because I'm still in the market, as of now, my March results are good. I'm up 20% profits in the month of March. So what I'll do next week is look at the trades that worked, show you some of them that didn't work, and try and relate them to the strategies that I've been talking about. I'm also going to be putting together a very brief educational video just to talk about some of the key lessons in terms of executing your strategy that led to the production of that 20% profit. So let's have a look at the CAD very quickly. I'm just going to pull it up. So we're going to go back to the 26th of March. And I've marked it for you guys so that it's easier for all of us to follow. So you see, so this is the 26th of March. On that particular day, I got up early and I was in the Asian session, which my time GMT is 2 a.m. GMT. So I happen to be fresh and alert, and it's going to the market and see if there are opportunities. And the market presented itself with pretty good opportunities, which I executed. So what we're going to look at is let's look at how it set itself up first. So there is the open of the day, right here. There is a crossover rather. So for me, this vertical purple line that marked the open, what I consider the open of the Asian session, and that's just the way I look at it. I look at when the Tokyo Stock Exchange opens for that first 2.5 hours. And I want to be in the market for that if I'm going to be trading the Asian session. Again, the usual setup. Now, I haven't put in the low of yesterday and the high of yesterday, just that I don't clutter my charts because I've got them in for today's present day. But on that day, I would have had the low of yesterday and the high of yesterday. So coming into the market at this particular moment, you always got to, before you cross the road, because of we drive on the left-hand side of the road, you always got to look left first, look right. Well, there's nothing on the right, but look left and see what has transpired. That gives you critical information, which you absolutely need to feed into your mind, because the market is moving, but you don't want to jump in randomly. By randomly, I mean you don't want to be lured into the market when your strategy isn't set up. That's the key to success. If I could call the 20% profits I made in March success, that's the key to success. Just do all you can to avoid being lured into the market by what's happened before you. It's always going to be, what is my strategy? I've got to wait for it. And it can be quite a long wait. It can be quite a long wait. You could literally just sit and nothing forms, And then when you kind of think, oh, nothing is going to happen, you come back and you're like, what happened? The what happens a lot. And when that happens, don't jump in. Just wait. Just wait. That's a bit of the thinking that you need to go through. You gotta be constantly. The best thing you can do is talk yourself out of trades. The best thing you can do is talk yourself out of trades. if I can say that repeatedly. So coming into the market, I would have seen all of that, and guess what I would have noticed first? And let's put it in just so that you can see how you can start to train your mind. This is coming into the market. I said, oh, hang on a second. There's a bit of a trade range here. Okay. So you'd have noticed that, and you say to yourself, well, okay, because I'm coming in, I can see that the bears are tending to break beneath that. But how far are they trying to go? Then you have plunked in the measured move. I mean, the more you do this just becomes a common default. Okay, so okay, if the bears are strong, they may want to take the market that far. And so what else do I see? This is coming into the market, and you're doing this, as quickly as you can. Well, we are creating lower highs. Okay. So I'm coming in right there. The market has been creating lower highs. Bears try to break beneath it. Let me see what's going to happen. And again, you look at the time there, 5 minutes for the actual open of the session. I'm always keen to see just what is going to happen with that first candle. Who is strong enough? Who's got the greatest momentum, the greatest muscle to control the first candle or the first bar of the session? Look at that, you get a massive bear candle, okay, which is a breakout candle because it's breaking out beneath the moving average, because the bulls there try to get close above the moving average. It's breaking below this this low here. It's breaking beneath this whole trading range here. And when you see that, the next question is, okay, are the bears strong enough to give me a second candle? Because if I see a second bear trend candle closing on or near its low, fantastic, I have a confirmed breakout. Now, the size of the first candle or the second candle, it doesn't matter, as long as it's a trend candle, trend bar, opening in this case of a bear move, opening near the high of the candle and closing near the low of the candle. So we had a confirmed breakout. So already in my mind, I'm saying, okay, confirmed breakout, and I know the bears are aiming for that. Now, where the confirmed breakout, maybe the move is ending because that's the measured move the bears want. But I do have a confirmed breakout. So let me wait and see what other information I get that I get from price action. So what do we get next? Next, we get at some point while it was forming, it would have looked like 3 strong bull candles. That candle, at some point, this particular candle was a bull candle, and it would have looked like, oh, okay, so maybe the bearish move is ended, because the bulls they're strong enough, they will put a close, on the third candle, a close above this breakout candle, then you know, okay, we have a big down, a big up, likely to have a bit of sideways price action, because that's another trading range that's formed. And always key to learning from experience, is always very important to wait for the close of the candle on any time frame. We have to wait for the close of whatever time frame, hourly time frame, 4-hourly time frame, daily time frame, weekly. The close is significant. And at some point, I will talk to you about when you use closes as well, because you always click on the line chart and you can see that's plotted against the closes. Very important. Computers look out for closes. You can just see what's happening because you can see there, where we are right now. It was trying to break above, so that's very strange. But we'll talk about that at some other time. In any case, on the close of this candle, okay, what do I have? I'm now saying, okay, fantastic. I had a confirmed breakout. I have a pullback. I'm seeing it as a pullback. Pullback to the moving average and the reversal, strong reversal by the bears. They managed to keep the bulls from closing above the moving average. So what I have at the open is a double top. Okay, it's a double top in a bear trend that the confirmed breakout. So I'm happy. Now I am actively looking and waiting for the opportunity to go short. Earlier on, I don't know which currency we're looking at when I say I don't like to trade just off the double top. I want to see a lower high. Just like it's not that I don't like to, it's not my strategy. I don't trade off a double bottom. I wait to see a higher low and then trade off that. There's higher probability of that going my way. So right now I'm saying right at the open, confirmed breakout, pullback to moving average. That's a double top, and it's just confirming strong bearish strength. But I need to wait to see if I'm going to get my lower high. So here comes. So at this stage, double bottom, but we're in a bear trend, which is a confirmed breakout. So nothing for you to do as a bull. You are in a bear trend, and you'll have double bottoms, a lot of bull candles, all sorts of bull signals, but you are in a bear trend. So there's nothing to do there as a bull. Just wait and observe. Unless you're a scalper, of course, and I don't scalp. I wait for my strategists to say that. So market came back to the moving average, and I had a reversal here. Now that's the lower high that I was looking for, and I'm absolutely happy with that trade. Happy to take it, and I took the trade, and I put my stop above here, above the double top. That's where I put my stop. That particular moment, I looked at it and said, I'm happy with it, and I'm gonna take a trade. It's confirming exactly what I had in mind. Okay, what I had in mind was to look for a lower high to take a trade, and I'm gonna set up and take a trade. Now, where do you aim to take the profits? That becomes a question. Because remember, we still had this measured move here. Let me just put it in for you, just to take the thinking a bit further. Okay, so you still have that, and that's something that you gotta say, okay, maybe the market will turn there. That's why if you trade in the any high time frame, if you trade in the hourly, if you trade in the 4 hours, if you trade in the daily, you can take a trade and go away, close your computer, and come and see what happens, whether you should take your profit there or not. But if you trade in the 5-minute time frame, things can move pretty fast and pretty dramatically. And a big thing for the success, for you being successful trading the 5-minute time frame. And also, I would say the 50-minute time frame, because I've traded that before, is trade management. Our business is to manage the trades that we've taken. We're in the market, and that's part of the fun. Let's manage it. Let's see what happens. So I know that at that measured move, the market could turn. And if it turns decisively, I'm happy to get out of the trade, and hopefully I can get out with break even. Or I can just wait to see if my stop gets hit. That's part of the trade management. So I took that trade, and then I had a very good entry candle. That's significant for me. When I take a trade, I don't want to see a doji. I don't want to see an entry candle that immediately reverses and closes on its middle. That's a cause for concern, because then I got to ask myself, if the bears are strong, why are they creating a doji? If they're strong, they have to give me a strong entry candle. So I had a strong entry candle, very happy with that, and then immediately there was a reversal. And this is a classic one to talk about. So strong entry candle, and you're happy with it, and look at it, immediately have a reversal. At some point, that trade on the second candle after the entry, was in a loss, followed by another candle, which if you ignore the price action to the left, you say, oh my goodness, look at this setup for the bulls, let me jump out. No, but no, let's wait and see if the bears are weak, then the market is going to trade above our signal candle, and that becomes a problem. But if the bears are strong, they will defend that and defend it pretty strongly. But we just got to wait and see. Now, this is also important. At some point, we'll talk about risk management, depth, and when to place your stops. You can't take a trade with random risk management and wish it's going to go your way, because you are going to panic, you are going to close the trade, and then it's going to turn, and then you're going to jump in, you're going to make more mistakes. Once you place that trade, make sure you're happy with your risk level. Whatever your risk level is, I'm comfortable to start with 1%. I go lower if I'm in a major trend reversal, because that's a 40%, but I'm very quick to jump in and start to move in my way. I'm comfortable going above 1%, 2%, 3%. I'm very happy to do that if I bank some profits and I'm in a trend and it sets up. But I understand my risk and my risk parameters, and that's something that you got to train yourself on. In any case, so there was my double bottom, there was lower high. Then immediately the bears reversed the market and created a double top with the double top that I traded. Now that for me is a very strong signal that confirms that the first trade was high probability trade. Now I'm even in a higher probability trade. So I remember I said I always talk of 60% trades. Now, when I see something like this, the probability has increased on this next trade. Is probably, I don't know, 65 or 70%, but it's more than the 60%. So very happy to enter the trade again, to put in another trade, and I did that. Now you've got choices. You can just sell at the market because you don't know how fast the market may drop, or you can put an entry beneath that and say, well, let me wait to see if it breaks beneath that. Again, it's the same stop. At this stage, understand if you're going in 1% here and going 1%, you are at 2% risk. And if your comfort level is 1%, and then you can't take the second trade. You can't. You just have to wait based on your comfort level. So I was comfortable with that. Then now at that stage, and I'm thinking, okay, so although I still have this measured move, and the market has created this pattern, what has the market done? Now, this is where I find at least price action very exciting. So at this stage, I'm seeing this. Okay, so it's a form of a triangle. And the triangle is breakout mode, because as I said, the market will never end up just going in a straight line. It will break out one way or the other. But how far is this breakout going to go? So you got to look at the height of the triangle. And the height of the triangle is from there to there, and you're saying a possible measured move of the height of the triangle is that the market may want to go to that extent. Okay, that's how far you think the market wants to go. Now, that's the most positive, most optimistic level that you trade. Now, you always want to see the most optimistic, but don't trade off that because you might not get there. So, what's the nearest measured move that the market might go to? There is this move that we've got, and now my double bottom that was created here gives me another possible measured move where the market might go. So I'm saying, okay, most optimistic, hey, if we get a breakout That's how far the market may go. That would be fantastic, good profits. But realistic first target, conservative profit target. There is a little trading range that I've got. See that? Out of that, that double top, I hope I said double top, not double bottom. Out of that double top, we have taken my trade. So market came from there. That's the first low I intend and created a double top there. So between those two tops and the low, I'm saying the market may make a measured move of that. So I'm happy to hold my trades. Now, if for any reason you have to go out, and you can't watch your trades, and that happens. And you don't want to come back and the market is reversed. You've been gone for an hour, it's taken its time, done a nice reversal pattern that you could have traded if you had in there and reversed and hit your stop. Okay, if you trade in the 5 minutes, because you've got to start to train yourself that if you are trading the daily time frame or the hourly time frame, things that can take hours or days to unfold can happen within an hour on the 5 minute time frame. So if you had to go away, then find where there is the most optimistic. There is another measured move. Just put your take profits in there. If it gets hit and you bank your profits and you come back and it is continued as a bear trend, that's fine. Wait for the pullback. Okay, so I don't have a take profit in market because I'm trade managing. I'm managing my trades as they are unfolding in front of me. So I see that taking place. Then I see the markets, the bears again. So from this triangle breakout pullback, and here we are, bounce off the 20 moving average. There is a bull candle. Now, if you are not in any of these trades, and if you saw this bull candle, and if you had analyzed all of this taking place, would you take that trade? Yes, you must take that trade. Now we're talking of 60-40 probabilities, which basically means that the setup is there, but things may not be as perfect as you want them to be. But it is a decent test. It's a test of the moving average. It's closing beneath its midpoint. So the bears definitely control that candle. So it's a decent enough high test candle. So you put your entry beneath that, and that's perfectly fine. But your stop always has to be in the correct place. I cannot overemphasize that. Your stop must be in the correct place, because market might just bounce out a little bit, because although it's a good signal candle, market could go sideways. In any case, we had a strong breakout candle. Why is it strong breakout candle? It's breaking out beneath that whole triangle pattern. If you hadn't seen the triangle pattern, that's fine, but it's breaking out beneath the lows, breaking out beneath the lows, breaking out beneath this low and that low. So you may not have seen it as a triangle. That doesn't matter. The fact is, you can see this is a breakout candle, and it's followed by another bear candle. Now, if you compare this bear candle and this bear candle, there's a slight difference. This bear candle here, you would have loved it to close near its low. Because if it closed near its low after this, you would have had a higher probability, or higher certainty in your mind that you might be going lower. But in any case, the bulls bought into the close. The bear still closed it. It's closing almost in its midpoint. But the bears, if they were strong enough, why didn't they close beneath it? So that would raise questions in your mind. But in any case, it is still a breakout candle followed by a bear candle, which is still closing beneath that, barely. So alarm bells in your mind, and you just wait to see. We then had the bulls try and create, they did put a market at the bottom here, attempt to reverse the trend, but they came off the 10 moving average. Now, every time I see the market coming off the 10 moving average, another result. So the market, the bulls went to moving average, tested the 10 moving average, and failed to break above it. that's a sign of strength, because I use the 10 EMA as an indicator of breakout strength. So that for me is saying, okay, I didn't have a strong bear follow through. It was still a bear candle. Bulls tried to reverse it, but they bounced off the 10 moving average. And there is a decent signal candle, inside candle. Remember again, inside, outside, inside candle. So that's a decent trade to take. Now, it's a decent trade to take, but we have a problem with our measured moves. Because of the measured moves, what I want to see is that kind of candle. Perfect. I love this candle. But I am hoping to get a second strong candle that closes beneath, because these measured moves are hidden levels of support. I'm hoping for a strong candle that closes beneath that will then say breakout and follow through. Because if I get that, then I'm saying, okay, maybe that optimistic level, we are going to get to that level. But we didn't get that. Same kind of pressure by the bulls, buying to be closed, buying to be closed. Now I have a problem. And then see the bull candle, and I'm saying, okay, I don't want to hold on to this in case we have a deeper pullback. That's one point. The second point, which I've mentioned, I'm only trading the first session of Tokyo Stock Exchange, the 2.5 hours. So by 5 o'clock, I want to be out of the market. So, and I'm not comfortable holding on to trades, into the second session, and then the early opening of the European session until the London session opens. There's just so much variability that takes place. So I'd rather take my profits and get out. So you take the profit there. Now here's what's interesting. When you take that trade there, because you're taking a breakout, pull the trade. The best place to put your stop is way up here. Okay, that's the best place that's the optimal place to put your stop. If you want to be a little bit more aggressive, you can put it above this lower high here. But this trade, yes, went my way, but this was not a one-to-one trade. These two were one-to-one trade, and this trade was not a one-to-one trade. But it was a profitable trade. Managed to get out with a bit of profit. So, guys, this is just the anatomy of part of the 2.4% trade. I mean, it's less than an hour. So it seems like a lot of work, but the more you work with these charts and price action, it actually isn't a lot of work. It's a lot of fun. I'll clear that up. Let me have just a quick look before we go. So earlier on, we spoke and we said, well, okay, happiness, the bulls closing above the moving average. Let's see if we get a double bottom. We didn't get a double bottom. What we have is what looks like an attempt by the bulls to break above this. If they do break above this, just going to put it here, what you're going to be watching out for is a possibility of a measured move up to here. What this means is that if we have a bull candle breaking above this and a follow-through bull candle, we have a breakout model. All we wait is for pullback to the moving average. If you get it on the 10, take the trade. If you get it on the 20, take the trade. But our first profit target is there. Yen, again, I gotta wait. I wanna see if I can get a double bottom somewhere here. If the bulls break out above here, there's nothing for me to trade here because there's this lower high that would stand in the way. And quickly just have a look at the euro before we have to sign off. Okay, so the euro broke out. So that's a strong bear move. Unfortunately, it would not have given us the entry because there is a hidden level of support where the market came off. I would have wanted to see a double top. And even if I'd consider this as my double top, I want to see the close beneath the moving average. I want to see the trend resume and give me a lower high, which I would have taken. In this particular moment, what we're waiting for, good bear strength. Let's wait and see if we get either a lower high or let's wait to see if we get a decent test of the moving average. At this stage, best to wait and see what we get. So guys, I know time is gone, and I don't have any question in the chat. So thank you very much for attending. And next week, we'll be talking about the 20% profits on the month of March, just some lessons out of that. Thank you guys. We'll see you next week.